All right, welcome everyone. Today, we're going to dig into a really core process in the accounting cycle, posting to the general ledger. Now, I know what some of you are probably thinking, that this sounds like one of the more tedious, mechanical parts of accounting, right? Just moving numbers from one place to another. But what I want to show you today is that this process, posting, is so much more than just bookkeeping. It is the absolute critical link that transforms the raw chaos of daily business into the clear, actionable intelligence that CEOs use to make multi-million-dollar decisions. You could say it's really the engine of financial insight.
So how in the world do they do it? Let's frame our whole discussion today with this question. Just think about a massive company like an Amazon or a Walmart. Every single second, it's processing thousands of transactions. A book sold in Ohio, a server getting rented in Ireland, a new warehouse lease signed in Japan, a payroll check being issued in India. How does that blizzard of financial activity get boiled down into an income statement that just says, hey, here's our net income for the quarter? Well, the answer is hidden inside the accounting cycle, and specifically in the crucial step we're going to break down right now.
So our first major step is all about creating order. It's about moving from chaos to clarity. Before we can even think about analysis or strategy, we have to build a reliable, auditable system that captures every single economic event affecting the business. This is how we move from that blizzard of transactions to the clarity of a financial report. And the first rule is simple, and believe me, it is non-negotiable in accounting. You record everything, and you do it in the order that it happens. That chronological integrity is absolutely paramount.
And that first record is made in what we call the journal. The best way to think of it is as the company's financial diary. Monday, we bought some inventory on account. Tuesday, we sold some goods for cash. Wednesday, paid the utility bill. See? Every single event is recorded in sequence. Now, this creates an indispensable chronological audit trail. If a question ever comes up about a specific day, auditors can go right to the journal and see a complete record. But here's its big limitation as a tool for analysis. If I were to ask you, hey, what's our current cash balance? The journal is almost useless. You'd literally have to scan every single entry since the company started, manually adding up all the cash that came in and subtracting all the cash that went out. It's just completely impractical for making decisions. And that problem leads us directly to the solution. This is where we start to create some real analytical power. The process is called posting, and you can think of it as a great transfer of information. We're going to take all that data from our chronological diary, the journal, and we're going to systematically reclassify it, reorganize it by account type, so that it actually becomes useful for analysis. This is the bridge that takes us from simple data entry to real financial intelligence.
This quote here really captures the mechanical heart of the process. We're transferring each debit and each credit from a journal entry into its proper home inside the ledger. And that home is a little device we call a T account. And yeah, it's called a T account simply because it's shaped like a capital T. It's such a simple shape, but it's beautifully functional. It gives you a left side for all the debits and a right side for all the credits. This systematic transfer into these T accounts is the core action we're focusing on today.
To really make this stick, let's trace a super simple everyday transaction. Let's say your consulting firm, it finishes a project and you get a check for $1,000. In your journal, you'd record this with a debit to cash because your cash just went up and a credit to service revenue because you earned that money. Now, right now, that information just exists as a line item in your diary, in the journal. It hasn't actually changed the balance of any specific account that we might want to look at.
So we post it. Here's how it works step by step. First, you find the cash account in your ledger. Second, you transfer that $1,000 debit from the journal over to the left side of the cash T account. Third, you go find the service revenue account. And fourth, you transfer the $1,000 credit to the right side of its T account, and you just repeat this for every single line of every single journal entry. It is meticulous, it's almost robotic work, but it is absolutely essential. A really common mistake for students here is a simple transposition error or posting to the wrong account. And if you get one of these steps wrong, that error will ripple through your entire financial system. And boom, here's the result. This illustrates the impact perfectly. Before we did the posting, our cash T account had a running balance of $5,000. After we post that $1,000 debit, the balance is immediately recalculated to $6,000. Now, if the VP of Operations comes to you and asks, hey, do we have enough cash to make payroll this Friday? You don't have to guess. You have a real-time, up-to-date answer. That is the power of posting. It keeps a current balance for every single account in the business.
Okay, so we've seen what happens to a single account. Now I want you to just imagine this process scaled up. Every single account a business has, cash, accounts receivable, equipment, loans payable, common stock, sales revenue, rent expense, you name it. Each one has its own T account with its own running balance. And they all live together in one place. And that place is the master file of the company's finances, the general ledger.
The ledger is the central repository. It's the master file. You know, if the journal is like that chronological stack of incoming mail on your desk, the ledger is the perfectly organized filing cabinet. There's a separate, clearly labeled folder for every single account. Posting is just the act of taking each piece of mail from that unsorted pile and filing it in its correct folder. This act of sorting is what makes all the later analysis and reporting even possible, and this structure, it's the foundation that's required by accounting standards like GAAP and IFRS.
So what's actually in this master file? Well, everything gets categorized into 5 fundamental types. You've got your assets. That's not just cash. It's things like inventory, buildings, patents. You've got your liabilities, which are the claims against those assets. Think bank loans or wages you owe to employees. You have equity, which is the owner's claim on what's left over. And then you have the accounts that explain how that equity changes over time. Revenues from all your sales and services, and expenses, the cost of doing business, like salaries and advertising. The ledger holds the entire financial DNA of the company, all perfectly sorted.
Okay, so we've walked through all the mechanics. But as future managers, strategists, and entrepreneurs, why do you have to really get this? Because whether you're deciding to launch a new product, or expand into China, or acquire a competitor, those decisions are rooted in the numbers that are organized by this very process. This right here, this is the payoff. This is the moment that all that boring bookkeeping transforms into the actual language of business strategy.
So what's the whole point of all this organization? Well, first, the ledger lets you see the flow within any single account. You know, how much inventory did we buy versus how much did we sell? Second, it gives you that up-to-the-minute balance for every account, which is critical for daily operational decisions. Third, from these balances, we prepare what's called a trial balance to do a crucial check. Do our debits still equal our credits? And finally, and this is the most important part, these final organized balances are the exact numbers that get copied onto the financial statements, the income statement, the balance sheet, that you will use to analyze a company's health and performance. This is how raw data becomes powerful insight.
So if you're going to remember one thing, remember this analogy. The journal, it gives you a chronological story. On Monday we did this, on Tuesday this happened. It tells you what happened and when. Posting transforms that story into an analytical encyclopedia, the ledger. And you can open this encyclopedia to any page, let's say accounts receivable, and get a complete up-to-date summary of that topic. Who owes us money? How much? Have they owed it to us for too long? It's a fundamental shift from simple storytelling to powerful, organized analysis.
Let's wrap this all up with a final, really crucial thought. We've established that the ledger becomes the company's ultimate source of truth for its financial position. Every report, every analysis, every major decision, it's all based on the balances that we find in this master file. But that leads to a critical question. What happens when that truth is built on a mistake? What if a debit is posted to the wrong account by accident, or a number is transposed? Well, the integrity of every single financial statement is immediately compromised. You could potentially mislead investors, mislead management, all because of one small error. This is why the accuracy of posting is so incredibly vital, and it sets the stage perfectly for our future discussions on things like internal controls, auditing, and the critical process of correcting mistakes.